Hey guys, Darren Sai from Know Your Mortgage, your preferred online mortgage education resource. Today, we're going to be talking about FHA loans in 2023. So, the first thing about FHA loans is that they are one of the easiest loans to qualify for. Typically, with an FHA loan, you're going to see a lower interest rate than conventional loans. The FHA loan is a great product for those with lower to middle credit scores, and FHA loans have low down payment options. So for those that have above a 580 credit score, we're looking at a 3.5% down payment. For those that have above 500, we're looking at a 10% down payment option. So now we'll be walking through some of the pros and cons of the FHA loan. As mentioned previously, FHA loans typically will have a lower interest rate than conventional loans. Additionally, they typically have lower credit score requirements than conventional loans. Also, with the 580 credit score and above, you can put as little as 3.5% down. On top of that, there are some rehab options for the FHA loan. We'll be walking through both of those, the FHA 203K Standard and the FHA 203K Limited. Last but not least, many people utilize the FHA loan by putting 3.5% down on a duplex, triplex, or quadplex. So you can actually purchase multifamily units with the FHA loan. Now, some cons. Typically, the FHA loan is not preferred by sellers. Part of this is because the appraisal requirements are a little bit more strict than conventional loans. Additionally, there is something called an upfront mortgage insurance premium. That will be 1.75% of the loan amount. Next, not all condo communities are FHA approved. Last but not least, FHA loans typically have a lower loan limit. Now, we're going to talk about some of the changes to FHA loans that happened in 2023. First, we saw higher loan limits. So in Orange County, a high cost of living area, the FHA maximum loan limit went up to $1,089,300. Riverside County, we saw it go up to $644,000. LA County, another high cost of living area, $1,089,300. And San Bernardino, $644,000. Another major change was the Biden administration lowered the mortgage insurance premium rates. So previously, the rate was 0.85, and now that's down to 0.55. For high balance FHA loans, that rate is down to 0.75. Additionally, they did remove some COVID FHA restrictions, making FHA loans more accessible. Now we're going to talk about FHA interest rates. So typically, FHA interest rates are lower than conventional loans because FHA loans are government backed. FHA loans are very similar to USDA loans in terms of interest rate because both are government backed. Now, compare an FHA loan to a VA loan. VA loans interest rates are typically a little bit lower. FHA loans also offer fixed and variable loan options. Additionally, with an FHA loan, you can get a temporary or permanent buy down. Overlays. What is an overlay? An overlay means that every lender has its own requirements. So not every lender will go off the minimum requirements. For example, we went over a minimum credit score of 500 needs to put 10% down for FHA loans. Some lenders might require a 550 credit score to do 10% down and qualify. Your best bet would be to connect with a knowledgeable mortgage broker that can walk you through the guidelines and the best lender for your scenario. Now we're going to dive into credit score. So you might be wondering why we have 3 different credit scores here. There are 3 different credit report bureaus. So we're looking at TransUnion, Equifax, and Experian. So I put 3 scores of 620, 650, and 615. We will be using the middle credit score of the 3. So in this scenario, we would use the score of 620. Now keep in mind, we've already mentioned this. Minimum credit score for an FHA loan is 500, but that is with a 10% down payment. If you have over a 580 credit score, we can go 3.5% down. Anything above a 620 credit score, we would want to compare the scenario with a conventional loan. Typically, the monthly payments have been lower with FHA loans, even with higher credit scores. Here's an example of a $500,000 purchase price. We're looking at a credit score of between 500 and 580. We put 10% down, that would be 50,000. Anything above a 580 credit score, we'd be looking at that 3.5% down, which would be 17,500. So another great benefit of FHA loans is there are multiple down payment assistance programs. One of the programs that is very popular is the Empowered program. A little bit about the Empowered program. The minimum credit score is 620. There are two different options for the down payment assistance grant. One of them would be a 2% grant. The other is a 3.5% grant. Either option, the grant is not paid back. It is a grant. Now, to qualify, borrowers must fall into one of the following categories. The first, be a first-time home buyer. Second, they would need to be retired, active, or previously volunteer as a medical professional, first responder, civil servant, educator, or military personnel. Another way borrowers can qualify is if they make less than 140% of the area median income. Now, this program, the Empowered program, is available to use for condos, single-family homes, and duplexes. Keep in mind, the program typically does have a higher interest rate than market for an FHA loan. The interest rate will depend on which grant option the borrower selects. Now, you might be wondering, how do I qualify for an FHA loan? So here is what lenders look at in qualification. The first will be gross pre-tax income. So they're going to be looking at your monthly gross income. The next, they'll be looking at monthly expenses related to balances. For example, auto loan, student loan, personal loans, child support, minimum credit card monthly payments. And so for FHA loans, when we look at debt to income ratio, the front end max allowed is 46.99%, and the back end is 56.99%. Now, that front end ratio of 46.99% takes into account your monthly housing expense, which would be made up of your principal and interest, property tax, homeowner's insurance, mortgage insurance, and HOA, and compares it to your gross pre-tax income. The back end takes into account the monthly housing expense and your other monthly expenses and compares it to your monthly pre-tax income. Another thing to consider is compensating factors and overlays. So we discussed overlays earlier, but compensating factors could be have additional down payment, or you have a high credit score. So keep in mind, with overlays, it's the opposite. So with compensating factors, these may allow you to go up to that 46.99% front end or 56.99 back end if you have good credit or high credit score, or if you have additional down payment. Conversely, overlays, we talked about that before. Each lender has its own minimum criteria to keep in mind as well. In community property states, they will be looking at your non-borrowing spouse's monthly expenses in addition to yours. So we talked about qualification and gross monthly income. Here's what we're looking for. We're looking for a 2-year stable work history. There's no time limit on over 2 years work history. Also, if you have changed jobs, that is completely okay. It is better if it's in a similar field or a similar role. Keep in mind, if you are a student in college and you just graduated, that is totally okay. They will take your school history as a part of your 2-year work history as well. Retirement is also not a problem. Now let's talk about gap in employment. So if you were off for 6 months, then we would need to be back to your job for at least 6 months. Lenders typically just want to see that you have continuing employment that is stable. For those who are self-employed, we are typically looking at an average of your 2 years of tax returns. In some cases, they will allow 1 year of tax returns if you've been in business for 5 years or more in the same industry. So with all FHA loans, we do have something called a mortgage insurance premium. Mentioned it before, it's one of the cons of an FHA loan. So there's two parts to it. First part is the upfront mortgage insurance premium. Typically, this is added to your closing costs. Some people will pay it upfront in closing. Most people add this 1.75% charge to their loan balance. So these are the numbers for a $450,000 loan. 1.75% of that would be $7,875. Additionally, there is a monthly charge. In this scenario, it's a 0.55% monthly charge. Every month, it would be a $206.25 monthly expense. Keep in mind, with high balance FHA loans, that 0.55 becomes 0.75. So when talking about closing costs, FHA loans are going to have similar closing costs to conventional VA, USDA loans with regards to potential lender fees, so origination charges, underwriting charges, discount points, paying for an appraisal. Additionally, going to be paying for title and escrow fees, recording fees, transfer taxes, depending on the county that you're in, HOA fees if you're buying a property that has an HOA. On top of that, prepaids, which are typically insurance, property tax, and interest. The major difference between FHA loans and others in closing costs is that upfront mortgage insurance premium that we previously talked about. Now we're going to talk about potential ways to have lower cash to close. So with an FHA loan, a seller is allowed to provide a max credit of up to 6% of the lower between contract price and appraised value. So for example, the home is listed for $500,000, but the appraisal comes back at $490,000. The seller is allowed to offer 6% credit of the $490,000 price or appraised value. Some ways that buyers have been getting seller credits. The first is asking for seller credits in lieu of repairs. So when someone purchases a home, we always advise to get a home inspection. And in that home inspection, there might be some items for repair. Instead of actually having the seller do those repairs, the buyers can ask for a seller credit. Another strategy is offering higher than the list price. For example, if a home is listed for $400,000, the buyer can offer a list price of $410,000 and ask for a $10,000 seller credit. At the end of the day, the seller would net the same amount in those two scenarios. This is why it is crucial to have a good real estate agent negotiating on your behalf. Now let's talk about property requirements for an FHA loan. The first requirement is that the borrower must plan to reside at the property as their primary residence. Previously, we also touched on this. FHA loans do qualify for single family homes, condos, and townhomes as long as the community is approved, and FHA loans can be used for up to 2 to 4 units for multifamily. Once again, it is very important that you work with the right real estate agent understands these property requirements, has the ability to look up if a condo or townhome is FHA approved, and they understand the requirements for the FHA appraisal. Most importantly, they have the ability to negotiate on your behalf. So in addition to the property requirements of an FHA loan, we are going to talk about appraisal process. So keep in mind, an FHA loan is government backed, which means that if the borrower defaults, when that loan is sold, the government will still cover the payments on that for the investor. Because of that, the requirements on the appraisal are more strict than conventional loans, which are private loans. So the first thing to consider is that an FHA appraisal will take into account health and safety. What that means is if there's chipped paint or if there's damaged wood, those items will be called out and will need to be repaired most of the time. So another thing to consider with an FHA appraisal is that the structure is sound. Government does not want to back a property that is falling apart or has major structural issues. Keep in mind, an FHA appraisal actually stays with that property for 6 months. What that means is if a borrower enters into escrow and gets an appraisal on a property, an FHA case number is assigned to that property. If the appraisal is complete, then if the borrower for whatever reason decides to back out of that escrow, that appraisal actually stays with the property, and any borrower who uses an FHA loan to purchase that property can use that previous appraisal for up to 6 months. So we previously mentioned potentially using the FHA loan for real estate investing opportunities. So there is a commonly used phrase in the real estate investing world called house hacking. What that means is the buyer actually lives in one unit and buys a multifamily, so a duplex, triplex, or quadplex. They live in one side and they rent out the other sides for additional income. For a duplex, it's pretty straightforward. Borrower lives in one side and they are allowed to use 75% of the rental income on the other side for qualification. Now, for the 3 and 4 unit properties, we have something called the Self-Sufficiency Test. And what that means is 75% of the rents must cover principal, interest, taxes, insurance, HOA if there is any, and there's typically some reserve requirements. On the next slide, we're going to be going over an example of the self-sufficiency test for 3 and 4 unit properties. So walking through a $600,000 purchase price self-sufficiency example, the first step is that we're going to calculate the monthly housing expense. In this scenario, it's going to be made up of your principal and interest, your property taxes, homeowner's insurance, and your mortgage insurance. So we'll calculate that, we'll add it all up. In this example, we have a total of $5,540 for the housing expense. The next step, you're going to calculate that monthly net rental income. So what will happen is they will typically take the lesser of the two. It will be a appraisal or lease. And in this example, we're going to say it's $7,500 a month, and we're going to subtract 25% from that for vacancy, which in this scenario is $1,875 for a total net income of $5,625. And the last step is to determine if you have self-sufficiency. So all we're going to do is divide that monthly housing expense from the net rental income. And in this scenario, we would pass the test because the net rental income covers the monthly housing expense. Previously mentioned, there are also some rehab options for FHA loans. This can be used in conjunction with buying a multifamily home. So there are potential investment opportunities using the rehab loans as well. So the first type is the 203K standard FHA loan. This will have a minimum of $5,000 for renovations. The great part about the standard is that it can be used for major rehab. So borrowers can use this to fix structural issues, roof, plumbing, foundation. Additionally, it can just be used to update the home. You can make the home a little bit more modern, and it can also be used for landscaping and a variety of other renovation options. The other option is the 203K Limited. Now, this option does not allow for major renovations, does allow for minor renovations, and it does have a maximum amount of $35,000. These renovation options can be super helpful in adding value to a home that needs some updating. So thank you for visiting our channel and keeping us as your preferred online mortgage education resource. You might be wondering, how do I get an FHA loan? The first step would be to email our team over at loans@knowyourmortgages.com. After we have that free consultation with you, we can review FHA loan details and explore other loan options. After we explore the best loan option for you, you'll be able to go home shopping with confidence. And once you find the home that you love, we can set you up with a partner, referral, real estate agent, and we can get your offer accepted. After we get your offer accepted, go ahead and close that loan, and you'll be on your way to becoming a confident homeowner. Once again, thank you from our team over at Know Your Mortgage. If you found value in this video, please subscribe. Have a great day.